And with that, I'll turn over to Jonathan Johnson, who will introduce our panel and moderate the session for you all today. Thanks very much.
Thank you, Ted, and welcome everybody. I'm Jonathan Johnson, the former chairman, CEO of Overstock.com, and a member of the Utah chapter of the National Association of Corporate Directors. We've got a great panel today, and rather than have me introduce each one, I've asked each of them to introduce ourselves before we kick it off. So I'll do it at the order that's on my screen. Frank, would you introduce yourself, please?
Oh, we're going to mix it up? Sure. Yeah. I am Frank Watanabe. I'm the president and CEO of Arcutis Biotherapeutics, and we're a publicly traded dermatology company. Been public on NASDAQ since January of 2020.
Great. Thank you. Rhett, will you introduce yourself?
Yeah, Rhett Neuenschwander. I'm one of the partners at Tower Arch Capital. We're a lower middle market private equity fund based in Salt Lake City, Utah, currently investing out of a $750 million fund that we raised about 18 months ago.
Thank you, Rhett. And Sam.
Sam Moore, Managing Director of Investment Banking for BofA Securities. I have offices in Salt Lake and New York. Been doing this since '99. I love M&A and I love the equity capital markets. Those are two things that I feel I'm pretty decent at, above average, and excited to talk to you guys today.
I would say we have more than a pretty decent panel that's more than above average. So thanks to each of you for that. You know, when we put this panel together at the end of last year, I think there was a lot of excitement and enthusiasm for what the investment market, the M&A market would look like in 2025. We're now, 2.5 months into the year, and it might be different than we anticipated when we were talking about this in November and December. We'd like to start with, well, first, let me say one thing, housekeeping. When people have questions, please put them in the chat, and I'll make sure we get to as many of them as we can during the panel discussion. With that said, we'd like to start with Sam providing a few slides to review where things are and maybe where he sees things going. So Sam, I'll ask you to do that.
Oh, perfect. And I'll kick this off just to hopefully just get the momentum going in this dialogue, and then we can open it up. I put these slides together about 10 days ago. That's what I have to do to get them approved through the BofA framework. They feel shockingly stale since it's been such an eventful few days. But let me just kind of walk through what we're seeing. Just left to right on these charts, consumer sentiment has rebounded from the historic lows and still below average, but we were on the right trajectory. And then you saw Lowe's and Home Depot, which people look to, they have pretty solid earnings, kind of, above expectations. And you saw that, some nice growth there in Q4. Dick's Sporting Goods in Q4 was their best holiday season ever of all time. And so this, we're now only in March, and that feels like such a long time ago. And Dick's recently revised their projections down today, but just to set the context, like we were feeling really, really good about the consumer up until basically the last 3 weeks. Some of the framework, as everyone on this board call knows, the U.S. consumer is 70% of the economy. And so it's almost impossible for the United States to go into a recession unless the consumer runs out of home equity or credit cards. And you're seeing the credit card data bump up here. So they're spending again, and the saving rate's down. Obviously, everyone saved during COVID. And so even though credit cards are hitting some pretty high levels, there still is a ton of home equity out there, like record amounts, given the increase in home prices. And so our economists would say it's virtually impossible to go into a recession. Maybe we're going to talk ourselves into one here, but statistically, when 70% of the U.S. economy is the consumer, it's pretty dang hard to do. And then on this bottom part, the consumer is continuing to spend, whether it's low income or middle income or higher income. It's been pretty dang consistent. Real wage growth continues to grow. And at some point, rates are likely going to go lower. That's going to be a boon. A lot of people are going to want to finally move after being in their homes for 14, 15 years. So we could see a rebound in movement, which will lead to additional consumer growth if mortgage rates ever decrease. This next slide, supportive macro indicators. Again, this slide feels 10 days old, but the U.S. is better positioned than almost any other economy in the world. CEOs believe that. The inflation is continuing to drop. CEO confidence, I call this chart at the bottom. CEOs are never going to answer this question correctly or truthfully. I wouldn't probably do it if I was a CEO, but we need CEO confidence to be up for mergers and acquisitions to occur. Unless they have confidence in their forecast, they're not going to go forward. And just as a side note, and Rhett can get to this, you know, Tower Arch is one of the best performing private equity firms that I know of, and we're lucky to lend to them for their transactions. You know, just a fantastic firm. And they don't do a ton in consumer, but at B of A, most of our consumer-facing transactions that we were supposed to go to market with, you know, we have the book written, you know, the confidential information memorandum done. We have our buyers list ready. We may have done some outreach. We have the quality of earnings done. We are ready to go to market March 1st. And probably 20 deals, I bet we start dialing for dollars on 2 of those right now. Just because on the consumer side, there's just a lot of headwinds now with this volatility. This volatility looks subdued here. Anytime the VIX index is below 20, that means, and Frank will get to this, that means you can do a public offering and raise equity and do a deal. Right now, that VIX in 10 days has spiked from like 18 to almost 30. And so effectively, in the last 7 days, the equity markets have been completely shut. We think that's going to change. We're trying to stay positive. That's our job, to stay positive. But right now, that VIX is at 30. And so as a board member, that's the easiest way to check if the markets are open or closed, is if the VIX is below 20, then you're in good shape. And then we were finally starting to see some positives, right? You saw the CEO confidence click up. You had markets at all-time highs. You had people finally feeling okay about their stock prices. We've had more stock buybacks on our desk in the last 2 days than our like foreseeable memory. So you have this weird phenomenon where CEOs still believe in their company and what they're seeing in their channels, you know, wage growth, you know, at least they're going to say positive same-store sales this year. So maybe they start buying back some stock, but the market's not really believing it right now. And so maybe just a couple bullet points of things I've heard just in the last 48 hours. So most investment banks have ratcheted up their inflation forecast by about 50 bips. So that's driven by tariffs and some of the incoming drama. The good news is the credit markets haven't budged. And so that means that since the credit markets haven't changed, that just shows that markets are really stable. So people are not believing a recession's coming. If you would, you'd start to see the credit markets crack. Our spreads have still tightened. You can still borrow at really good spreads, even though rates are high. The bad news is because the debt markets aren't cracking, there's probably very little chance we get an interest rate cut in the near term. When you think about catalysts, the market right now is devoid of catalysts. No one is going to get rewarded for playing offense in this market. So no one's, you know, going out there and buying stocks. Everyone's, you know, being more conservative, waiting to see what happens with tariffs, et cetera. You saw Delta cut their forecast. That was a big deal. The core theme of CEOs over the last 48 hours has been we are focused internally. So no one's really focused on M&A right now. That is completely changed from 6 weeks ago. Every conversation was, this is going to be the year we do a strategic M&A deal. And within the 6 short weeks, it's gone to, we're focusing on internal initiatives. And then I mentioned Dick's, and the reason Dick's is such a good comp is Dick's is probably one of the best retailers out there. No one needs to go to Dick's. Everything you can get there is at Amazon, but you go there because of the assortment. It's available. It's priced right. They have a really good private label. They just broke records. And so it's, all other specialty retailers than Dick's. And Dick's just guided today, below expectations. They get same-store sales in that 1% to 3% range, which is, probably at least 1 to 1.5 points lower than what they were forecasting just 6 weeks ago. So those are some kind of the core themes. And then the IPO market, I'll end on this slide and turn it over to Jonathan. We need the IPO markets to be working. This is, investors have been on the sidelines for 2 years now. If you're at Fidelity, T. Rowe Price, Wellington, you don't get rewarded and extra bonuses if you can't beat the S&P 500. And there's 2 ways to beat the S&P: choose better stocks or get in early on IPOs. And so everyone has been waiting. We've had great pre-IPO roadshows, and with the VIX where it is in the last 2 days, a lot of these companies you see on the right that were trying to get out this year, likely, it's going to be mixed. We'll see what the next 3 months holds. But I'll stop there, Jonathan.
Sam, thanks. A lot of information, a lot of good information for us to think about. Brett, let me ask you a question. As private equity firms look at their portfolios, particularly given this backdrop that Sam's provided, how are they thinking about exits this year, whether that's M&A, IPO? What kind of things are PE firms thinking about?
Yeah, it's a good question. And exits are always, top of mind in terms of returning capital to your LPs. A lot of it is driven by, much like the public equity markets, windows and opportunities of when there's a good market to sell into. I think what we've seen, and probably a lot of other private equity funds over the last probably 12 to 18 months, is an economy that's been a little bit more stagnant as rates have gone up. And so growth has been harder to come by at a lot of portfolio companies, which has driven, more kind of flattish results. And it's harder to sell into those sort of results and get the returns you want. And so I think what you're seeing is a lot of, and the data proves this out as well, where private equity funds are holding assets longer now and doing more work to really try and cut costs, drive cash flow, and particularly when interest rates have gone up and the companies are levered, being able to be more efficient operationally to free cash up to still make investments despite some higher debt payments is important. And then looking for any ways to grow. And, I think the market's kind of seen some of the consumer weaknesses. Our businesses are typically a little bit smaller. And so I think we've seen some of this weakness even into Q4 last year, and some of the businesses that have more of a discretionary spend component to them. So, the consumer's been a little shaky for a while in our minds.
Okay, thank you. Good information, good insights. The Wall Street Journal reported last month that companies are excited about the administration's focus on fossil fuels, lower taxes, deregulation, but there's a lot of confusion over tariffs, deportations, federal cuts getting in the way. Uncertainty certainly hampers long-term investment, and in particular, sometimes research and development. Frank, in the biotherapeutics and the pharma businesses, seems like it's all about R&D. What are the political impacts that you're seeing in your business and industry right now?
Yeah, as you said, R&D is really the engine, especially for the biotechnology sector. Less so big pharma, where they have significant inline revenues. And I think the uncertainty that we've seen unfold over the last several months has really created a difficult environment. Biotechnology is it's very capital intensive, very long timelines, and significant risks. Most biotech companies don't generate any revenue, and the uncertainty creates an environment where investors are risk off. And I certainly don't think of biotech as a defensive play. The XBI, I think, has held up so far reasonably well, even in the last a couple of weeks. But I think the environment and the uncertainty that has arisen in the last 3 months has created a very difficult environment for all investors. But I would say it's going to be very challenging for the biotechnology sector.
And are there things on the regulatory front in particular that have popped up that are impacting how you look at investments?
On the regulatory front, the FDA, it really has three large components. There's a device section, a biologic section, large molecule section, a small molecule section. The cuts of the FDA so far have mostly fallen on the device side of the house, and I think that's going to be very disruptive on that side. It's still not clear what's going to happen in the other two divisions. That would be very, very damaging if there were changes on that side. But I think also there's a morale issue and a retention issue at the FDA in general, and I would say probably across the federal government right now, given some of the policies, particularly coming out of DOGE. But we haven't seen a direct impact as of yet. In fact, we personally received a confirmation from the FDA since the beginning of the year that we had a regulatory filing that was on timelines. So that was encouraging, but I don't think that the dust has settled at the FDA.
Okay, helpful. Sam, what do you see as the impact of the continued zigging and zagging of the administration? I think this may go to a question that showed up in the chat. Jose asked, how did we go from a stable outlook to recession fears in such a short time? What's your thinking on the zigging and zagging and the including in sentiment?
So we're human beings. We do overreact, and sometimes we also underreact. I had a client that was slightly behind projections in January and February, and I didn't think much of it because they were still 20% ahead of their of last year and still doing really well. But they started to worry because they thought they were going to be 30% ahead, and all those fears turned it out to be real. And you start to really see the consumer pull back in late February, early March. And so anytime you have, one of Trump's gifts is, he's an agent of chaos, right? That's part of his negotiating strategy. And so I think it's helpful to talk about people's, challenges and superpowers. We all have them. It doesn't matter what side of the aisle you're on. And so we can talk about this openly. And it's going to be dramatic for at least the next 6 months, I think. And I do think recession fears are overblown. Statistically, I don't see how it could happen unless we talk ourselves into it. There may be a slight blip, but for the most part, the consumer is going to be resilient until they can no longer be. But when you're a consumer electronics company and let's say you're 50 in EBITDA and you get hit with a 20% tariff out of China because you hadn't diversified your supply chain, that's an $8 million hit to your EBITDA in theory. That's a big number. And that's going to cause, CEOs to pause and pull back and re-engineer their supply chains. And that can take some time. And the funny thing is as board members, we're dealing with this all the time. Like, we all saw what happened with Mexico. Some very large biotech companies moved operations to Mexico, along with the auto dealers, and wages tripled in some areas. And so what we thought was going to be a really good boon to profits, evaporated due to competition. And, tariffs weren't involved there yet. It was just, the global economy working in tandem to find market efficiencies. And so we're going to have that. And, but it's going to be messy, Jonathan. Like, I have a really hard time looking boards in the eye, and giving good advice, except to focus internally right now, and let's see what the next 100 days look like.
Good. President Trump and the administration are making serious efforts to boost America first manufacturing, and tariffs are clearly part of that. Rhett, how do America first efforts influence what companies you're looking to invest in and how you're treating the companies you're already invested in?
Yeah, it makes it a lot harder to look at companies that, as Sam was alluding to, that have an overseas supply chain risk right now, particularly when you're in some of these countries that he's targeting or may be targeted. And a lot of products come from China. Obviously, you've got also, in some of our companies, Mexican operations. And so the uncertainty that it creates there. I think the other problem is, as you think about tariffs balanced with the current immigration policy, we need workers. We need more workers. We have problems at our companies finding, workers. And so if you're going to want to produce more in America, you've also got to have an immigration policy that goes along with providing more workers to get that work done. And so to me right now, the squeeze is, you can't have both. You can't have these high tariffs, and you can't have an immigration policy that doesn't allow for American manufacturing to happen. And you can do some of it through automation, but that only goes so far. So, for us, and I think a lot of people right now, we're in a little bit of a wait and see mode. We're not, looking to charge into anything just yet with all this uncertainty. And I think that that's the same thing you're seeing in the public markets, where people are pulling back and maybe going a little bit into some cash and trying to figure out where does all the dust settle, because it's Sam said, the chaos. It's hard to see exactly how all of this is going to play out and what the timeline, is that we're on.
Yeah, I think that comment on immigration is really spot on. It's true for both skilled workers and unskilled workers, whether it's H-1B folks or, folks that are cleaning the space. It's become a real problem. Frank, I know a lot of the inputs in your business come from are imported. So how are tariffs impacting investments and deal flow in the biotherapeutic space? And when you get these tariffs and it increases cost, how much is passed along to consumer? How much is eaten and reducing EBITDA? Give me your thoughts there.
Sure. Yeah, I think across the industry is very heavily reliant on overseas manufacturing, and probably as importantly, overseas inputs. Right, the U.S. essentially doesn't have a fine chemicals industry anymore. It's all been outsourced to China and India. So even if a drug is made in the United States, it's probably being made with chemicals that are coming in from India or China. Particularly generic drugs are almost entirely made. The United States doesn't make any antibiotics at all. And so one of the issues that Congress has been looking at is how we're going to onshore some of our manufacturing from a national security standpoint, and how long that's going to take. The tariffs are a big problem, I think, for the industry because of our reliance on overseas suppliers, and because of the amount of time it's going to take to onshore some of this manufacturing. The industry is estimated it might take up to 8 years. There was a bill in the last Congress trying to move a lot of the manufacturing back from China, and our best estimate is going to take about 8 years to move the manufacturing, develop the expertise, as Rhett mentioned, and rejigger supply chains. Arcutis is in a position where we're probably not impacted as many as most companies are, because we do our manufacturing predominantly in the United States already. But the industry, I think, is going to struggle with this. And contrary to popular belief, our ability to pass those higher costs along to customers is going to be challenging, because our contracts, all of our contracts with the insurance companies, typically have price protection clauses where we can't increase our prices by more than X% a year. And it is well short of 25%. So I think there's a risk of a real EBITDA squeeze, especially at the larger companies that are importing a significant percentage of their manufacturing from overseas.
When you talk about 8 years to shift manufacturing capabilities, that's 2 administrations, in the way we pendulum back and forth, that's just a hard thing to plan to. So
it is, but although I do think that it is going to happen regardless of the tariff policy, because there's a national aspect policy as well, right? We don't want to be in a position where we're reliant on a potential future adversary for medications that are critical for not only our public, but for our military, right?
Yeah, good point. Sam, any other impacts you're seeing from America First efforts, whether it's tariffs or otherwise?
The tariff thing's real, and it's going to be a minute to see that flush out. It is fairly shocking, though, just to think through. I'm not sure it's publicly disclosed, so I got to be careful. There's a global large healthcare company that invested, I think, $300 million to move a large chunk of manufacturing to Mexico, and they keep delaying that every quarter. It may not, one, it's, these are medical products, so they're complicated. 2, they have to adhere to all these standards. 3, the wage pressure in Mexico has been real, and now you layer on tariffs of that. And, well-meaning, smart CEO, CFO looks like they made a really bad decision to build that factory right now. And that's really dramatic. It's dramatic for board shakeups. It's dramatic for decision-making. I think we have to be careful, as well as leadership teams, to take individually ownership of these responsibilities, because I'm not sure I would have done anything differently if I was that large global strategic that looked to build that factory in Mexico. I think I would have supported it. I think I would have done it. And now it looks like a really bad decision. So
Interesting. Let me go to a question that came up in the chat. Christy first opines, consumers may not be as sanguine about disruption as board members. And then asks, besides credit card debt and available home equity, what are other consumer metrics or indicators that you think are worth following? I'll open that up to anyone on the panel. What kind of things what metrics are you looking at?
I'll start, and then I'll let the others jump in. We publish a credit card survey. Feel free to email me, and we can give you access to BMA research. But I think it publishes every 2 weeks, and it's just credit card spending by category. And so you can see when times get tight, where do the consumer, gyrate their spending patterns to. And so that's interesting. And then I also do spend a lot of time on same-store sales for the retailers that I respect and that I know are on point and on cue. And I think it shocks a lot of board members, if you look at your favorite retailer and you go back by quarter for 10 quarters, nothing is a linear 2 to 3% same-store sales growth every quarter. It just doesn't happen. It jumps around like a jackrabbit on crystal meth. Like it's shocking. and that's life. And that's our economy when it's 70% driven by the consumer. And so those gyrations, I would temper sometimes. I'm just saying this. I've seen board members overreact to an 8% down same-store sales comp when it bounced back the very next quarter to something closer to like a 2% loss. So these things happen, and again, I think it's really hard to bet against the U.S. consumer. They will spend until they're out of money, and that's been proven for the last 50 years, with the exception of 08, 09, 010, when home equity got ripped out. But you look at some of these, if you need a new couch and you have to have it, you're going to go and you're going to do a lease to own. Some of these lease to own financing companies have been the fastest growing financial services companies in the country. Buy now, pay later, right? People are going to go buy that couch. It's weird. It's a little sad, but that's what we do as Americans.
So Sam has given us a new metaphor for high beta and volatility. Any other thoughts on important metrics to look at, Frank or Rhett, things you watch?
I wouldn't say recession proof, but we're pretty immune to consumer sentiment. So we actually don't track it in the biotechnology sector.
I'll just add another thing now, maybe a little bit of a different angle to it. When you look at all of the federal cuts that are happening, there's a lot of federal employees that are being laid off right now. You look at the amount of spending that government spending contributes to the economy. We need to cut government spending long term, but in the short run, it does create some pain, and all of those workers at some point are going to need to go and find and be reabsorbed in the private sector. And so there will be just some additional disruption and things that are going to happen as we right size the government, if you will. And I think that's an additional, thing that's going on here in the economy that is going to be disruptive. And as I said, in the short term, I think it's going to create some additional pain in terms of spending.
Yeah, it'd be interesting to see whether buyouts create or kind of like a subsidy that increases spending, or we have people unemployed and that decreases. There's a lot of volatility there. Rhett mentioned immigration. It's clearly another America First agenda item, and immigration has changed our demographics, and immigration reform is changing our demographics. How is all this impacting deal flow, investments? Rhett talked a little bit about it, but what do the others on the panel think the impacts of our current immigration are?
So maybe I'll start. The biotechnology sector is a science-driven activity. Something like a third of all doctoral students in the United States are foreign-born. And you go to any biotechnology company, and at least half of the scientists working in the laboratory are foreign-born, especially from Asia. A lot of South Asians and East Asians. Now, those aren't illegal immigrants, right? I think Rhett mentioned this before. There's a lot of talk about illegal immigration, but the H-1B program, the L-1B program are vital to the competitiveness of this country. And I think instead of, if we're going to focus on dealing with illegal immigration, that's fine, but we should be looking alternatively about how we increase legal immigration, especially of highly skilled workers. Clamping down or creating an unfriendly environment for immigrants is really going to damage the long-term competitiveness of the United States, and it will impact biotechnology because of the overwhelming role of immigrants in the science and math fields.
We need a working door, is what we need. We need a working door that lets people come in. So, other thoughts, or do we move on?
No, I said earlier, you need it. I think just across the entire spectrum, we're short labor in this country, and you think about all the money that's going into data centers right now, all that construction, everything that needs to happen. You need people to do that, and so we've got to be smart about it's not just the tariffs and let's produce in America, but it's then, okay, well, how are we going to do it? And you've got to, I think, as a board and as a CEO, see some clarity, because these are long-term investments. you know, and you've got to lay out capital plans that are long-term. And as Sam said, you can look foolish pretty quickly if you get it wrong against the policy that 12 or 18 months ago, that made total sense. And now the policy changes and suddenly it doesn't. And I think that a lot of people are going to be hesitant to make these sort of commitments and capital outlays until they see some clarity around and can get a better sense of what the payback's going to be.
Good insights. Great insights. We're seeing,
but-
go ahead, Sam. Sorry to interrupt.
No, just one more note to that. We need to be honest about the data in terms of we can't end up like Japan or China. Like if you get bored at night, go look at, you know, China's demographic data. Like you could argue that 7 to 10 years from now, you know, like we're really, you know, China is going to be in such a pickle that I don't want to say it's not relevant, but they're going to have so many challenges demographically. And if we don't have a door that works efficiently, you know, we're going to end up like, you know, Japan with, you know, a couple million extra homes that no one needs. And so we need that door open, and it needs to flow. You know, if we're not going to do our jobs and keep replacement rates above, you know, 2 times, then we need to have a robust immigration policy. And it's just math. It's not political.
Yeah, Sam's absolutely right. You know, the U.S. population already is not growing without immigration. Or we're not at replacement rate without immigration. So, you know, you can see what's coming if we don't seriously address the immigration question.
Well, I think the encouraging thing is we're still a place people want to come. We're the next best hope for so many people that the working door feels like it has to be part of the solution. We've seen, I wrote down, we've seen lots of cost cutting by DOGE. I think I probably revised that. We've seen a lot of noise around cost cutting by DOGE and executive orders. And then there's deregulation efforts. Frank, will federal reductions in investment in biomedical R&D impact the industry? You know, what uncertainty is DOGE creating? How is all this impacting 2025 investment thought?
Yeah, so, you know, cuts to areas like NIH, cuts to true government research will eventually have an impact on the biopharma sector, but it's going to be many years down the road, right? The government really focuses on enabling basic research is probably 10 years or more from the marketplace. So we're not going to see the impact of these cuts until 10 years from now. Where I do think there's potentially some immediate impact is, you know, a lot of small biotechs rely on things like the SBIR and the STTR programs. And if those get cut, that's going to have a very immediate impact on especially the earlier stage companies, some of the private companies. And then I think, you know, CMS, what happens at CMS is going to be important. You know, about 40% of Americans are covered by either Medicare or Medicaid, and disruptions to either of those programs can have a pretty immediate impact on the bottom line in the biopharma sector. I think we have to see what the actual cuts end up being if there are cuts. I think both Medicare and Medicaid could be politically fraught for the administration, but I think those are going to be the areas where we see a much more immediate impact. The cuts in R&D, they won't show up until it's too late, many years from now, and it's going to be very difficult for us to recover from.
Red, how's deregulation impacting how you look at the M&A markets and investments?
Well, it hasn't really fully happened yet. So, you know, I think it's in line. I think, you know, there's going to be some opportunity from it. I think we need to see a little more clarity on the extent of it before we really start to form much of an opinion or act around it.
Couldn't agree more. And I also think we talk about deregulation, but then we also see the Trump administration saying we have similar antitrust views around Google yesterday to the Biden administration. So sometimes there's this horseshoe where the two parties seem far apart until they're close together on some issues. So, Sam, anything to add? And I was going to ask you any thoughts around the change in the Foreign Corrupt Practices Act. That seems like a big change in kind of how businesses can do business.
No, I have not followed that, Jonathan. The Doe stuff, wait, I think last month was the first time in I wish I was trying to find the stat on my phone, but it was the first time in 20 years where government employment didn't grow. And so that obviously is going to have an impact, to Rhett's point, on the consumer, on the economy, on the labor markets. In theory, maybe it offsets some of the inflation that comes from tariffs, with some more available job seekers. But this is just going to be a washing machine that we're not going to be able to get our arms around until we see everything flush out. But the HSR stuff, I can talk to a little bit. I think that's fair. I think the Trump and Biden administration see things fairly consistently. It's government. It's like in Frank's world, like some of the products I thought would sell through the FDA get held up for years. Some of the M&A deals that I think are layups and make 100% sense get held up for years. I think we saw, the Vista ammo deal. For those of you, I'm not sure the makeup of this call, but I think it was a pretty material transaction for the largest bullet manufacturer in the country to be sold to a Czechoslovakian bullet manufacturer. That was a multi-billion-dollar deal with brands that all of you know from when you had your BB gun as a kid. And to have that go to a foreign entity, I think speaks, a few things, right? It speaks that the world is flat and we're trying to be more open to, having these companies be acquired by, foreign entities. That's good for business, I think. But also it's a material Second Amendment, hunting, defense, has some Army contracts. Like Vista was is a large multi-billion-dollar bullet manufacturer, and the government let that go to the Czechs, which I think is interesting, right? Like I think that's pretty fair. Like I would have voted in favor of that, and I think a lot of people would have said that probably should have stayed in America for national security interests. But I think they made the right decision. Hopefully, these are hard.
And you mentioned government employees maybe impacting how this works. I do think, as Robin mentioned in the comments, there are different regions that will feel the cuts differently. DC has been kind of recession proof as the federal government always grows. That feels like it may be changing, and so there could be dislocations that are regional that we haven't thought about in the past. We can't talk about the investment environment without talking about interest rates. Interest rates were coming down. Now they aren't. Rhett, how do you referenced this a little bit earlier, but how do interest rates and their change impact your investments? I know there are debt covenants like fixed coverage charge ratios, and how do you deal with kind of interest rates being an unknown all the time?
It's interesting. For a long time, and the fixed charge coverage ratio never really came into play because interest rates were so low and the economy was good and you had plenty of cash flow and you were always well above it. Suddenly, in a levered business, when you get doubling of interest rates and on a meaningful amount of debt and then some softening in the economy, that metric comes into play again. And so companies are looking at that, and you're having to really look at what do we have available to spend on some of these CapEx projects or some of these other areas that we've had, and really tighten the belt there and try and think about where, where is it absolutely necessary, and maybe where can you make some cuts and still get by, or find some other ways to grow. So it's definitely made it more challenging. I think it's particularly frustrating for us where you have companies that have delevered some, have a great business, and arguably should be paying a lower, rate, and suddenly, when it's a base rate plus a spread, and that base rate balloons on you, there's really nothing you can do about it, despite how good your business is or how well it cash flows. That cash flow, or a portion of that cash flow, is now being spoken for in a way that it hasn't been historically. So it's definitely changed things, changed the way that we think about levering the businesses. We don't want the leverage to get in the way of growth, so probably taking a little less leverage now, I would say, on average, with the rates going up. But all in all, it's definitely been challenging as rates have gone up, and particularly as quickly as they went up. It's really amazing when you look at the charts at how quickly the rates came up, and it needed to happen. But as we look going forward, we don't see them coming down anytime soon, and that's what we're banking on.
Sam, anything to add on interest rates?
Yeah, look, I'd love to toe the party line that's at B of A and say that rates are going to get lowered this year, and I don't see it. I'm with Rhett. I don't see a rate cut this year. I have a hard time seeing how that happens. We'd have to, I'd have to be, I've loved some of these comments on the virtual, message board. I would love to, part of me is, I'd love to be wrong on the U.S. consumer, and that maybe we do get a quick recession in Q1, Q2, resets expectations, lower interest rates by 50 bips, get mortgage rates closer to 5.5%, and a more moderate, stable place. But I don't see that with the way inflation's coming in on everything, even with some of these government layoffs. And it is going to be a challenge for these government employees to find jobs. I 100% agree. They're going to, to change your career mid-career is difficult. So I'm very sensitive to that.
Let me do one other topic before we wrap it up. We can't talk about investment strategies in 2025 without mentioning artificial intelligence. It's on everyone's lips. Frank, how's AI changing the landscape of your business and investing decisions?
Honestly, I think that the jury is still out on how AI is going to impact biopharma in general. I think there's a lot of potential, particularly early on in the drug discovery realm, but that's actually a fairly small chunk of the overall biopharma market. I think we're going to see increased productivity. I think we're going to see some unlocking of new innovations. I think to like AlphaFold's development of the ability to predict how proteins fold, that is going to be, I think, a groundbreaking innovation. But the broader impact on things like drug development and commercialization, in my mind, is still very much to be determined.
Rhett, how's AI impacting the way you're doing deals and making decisions?
For us, we've invested more in kind of the picks and shovels model so far of building out the data centers. Sam's been involved in some of these efforts here at TowerEdge with us, and that's one area where we're just seeing an unbelievable amount of spend in terms of money that's flowing in to build the data centers. I think it'll be interesting to see then how quickly those get absorbed, and what are all of the various use cases and the way that plays out. But the money is certainly going into building them to find out. And so I'd say at this phase we still view that or this phase of the game is still in the early innings, and see a really nice opportunity there. And then, you know, as it moves more into the software and the technology that's out of it, that's probably not a Tower Arch investment phase for us. But right now, as all of this is getting built, we find it really interesting to be involved in those build outs in a number of, you know, kind of industrial and construction services areas.
Great. Let me close with one question I have to ask to each of you. What are the top 1 to 2 topics you're hearing at industry meetings or discussing at board meetings? And Sam, I'll start with you.
I'll go back to focusing internally in a world where there's going to be chaos for 6 months, and hopefully it's limited to that. You got to focus internally. That Fed put, where I'd call it generic private equity firm. That's the PE firm that makes their alpha off lower interest rates and leverage as opposed to doing good deals, or, you know, that's kind of over, right? PE firms from here on out have to do good deals. And so focus internally, do good deals, hire good people, don't be afraid to right size. A robust, you know, we used to kind of make fun of supply chain guy that was kind of a 3rd or 4th tier position at our companies. Now it's is that now a C-suite position, right? Those are really important things to consider.
Yeah, great. Rhett, top 1 or 2 things you're hearing at meetings or discussing at meetings.
I think, to Sam's point, you really don't have any option but just to focus internally, because there's so much going on externally that you can't control. And so really looking at your own business and saying, how do we get more efficient? How do we automate? How do we think about where we're deploying our capital and making sure that it's efficient, and looking for ways to cut costs and right sizing your structure for probably what's going to be some softer spending in 25, where I think a lot of people were banking on, you know, the promised golden age, and that's a little further out, you know, is the way it's looking now. And so how do you hunker down, survive, and be ready to pivot your business quickly, depending on, you know, what's going to come at you with tariffs or consumer spending or whatever else. It just feels like now is the time where you really got to take, you know, kind of take the wheel and be in charge of your own destiny, and you know, try and navigate through these changing times as much as you can.
Great. Frank?
Yeah, I think we've touched on one of the main things I'm hearing about. I think tariffs are certainly front and center in everyone's mind, particularly the unpredictability, right? I mean, think about how many times the government's policy has changed in the last 3 months on tariffs in Mexico and Canada. It's very difficult to operate a business in an environment where you don't know from day to day what's going on with your supply chain. And I think Sam's comment about the importance of supply chain is really very relevant. In my sector, I think the other big thing that's weighing on people's minds is it's still not clear what the direction of travel is with regard to public health. You know, is the RFK view going to prevail? Is Macri going to prevail? We really don't know where the government is headed, the administration is headed in terms of vaccines, biomedical research, and a whole range of other issues that will directly impact on our sector. And I think that's weighing on boards and investors and executive teams across our whole industry.
Thank you. Frank, Rhett, and Sam, thank you. When we first got together and discussed this and looked at the landscape a few months ago and look at it today, you've been very flexible in figuring out what kind of things we would discuss. And I think it's been a great discussion. Thank you for participating.